Welcome back guys to another video. Now in this video we're going to be asking the question, when should we, if ever, trade against our pre-established bias? Now of course, if you don't know how to establish a bias, head to the part 1 of the Keep It Simple series and you're going to be able to understand that concept in full. But if you already know how to do this, why and when should we ever go against our bias? Now really it's not a good idea to do this, but there is always going to be an opportunity to take a trade against your pre-established bias if the relevant points are applied. And of course, we know what we're looking for in the market and we know what we have within the market to use as a tool for visualization and understanding of where the large banks are. Remember, we're keeping it simple, so we know the simplicity of the market is always at the heart of our understanding and what we are doing. So what we're going to do, as always, we're going to run down to the diagram chart. We're going to draw some short diagrams for you, and then we're going to show you some examples of this principle on the live price chart. So let's do it. Okay, so here we are down on the blank canvas that is Picasso's easel. Now you're going to see me draw some amazingly high detailed quality, top-notch NFT quality pictures. Of course, you know that I am being completely ridiculous by saying this, and we're just going to show you some very crude drawings so you guys can understand the principles that we have taught you up until now. So we're just going to start off with the main principle. What is it that when we see highs and lows, they represent? We already know it means liquidity, liquidity, okay, and liquidity. Very, very simple. We understand that depending on what our bias direction is, depends on what point is relevant to what. So if we're bullish, we know that the liquid highs become our targets, and if we're bearish, we know that liquid lows become our targets. Very simple concept to understand. The Keep It Simple principle is based around this whole understanding and premise. If we have a bias time frame, for example, the daily, we can use this as our highest level of liquidity, understanding that the daily bias, highs and lows, give us the highest possible levels of liquidity available to us within our trading system. Now, of course, this is going to be unique to every person because each person is going to use a different point within the time frame understanding. But what we are going to be looking at today is if we were using the daily, as I do very often, and our bias is down, for example, and let's say we have a very clear daily low that we have highlighted as a target. What is it that we are predominantly doing during this period? Well, we're looking to sell the market, of course, right? We're looking to sell this. We know that this is the highest level of liquidity within our given time frames, as I said, and we are now looking for this to be reached. Now, this, of course, is where we begin to ask the question, should we ever trade against our bias, which we have pre-established through our daily time frame, through the data-driven strategy that we have? Should we ever go against that? Well, really, in short, the answer is no. But there are scenarios and times when you can do this. This is one of them. So when you interact with one of your target lows, for example, right here, you are going to have, by probability, your daily bias being down, a high level of liquidity seated at this low. There is a high probability that on your entry time frame, if you see the money in, money out, and a clear point of entry, that there will be a short-term move that will come out of this. Now again, we are not telling you to take every single counter trade move that is offered, but if you are sweeping your bias time frame, so your highest point within your given time frames, there is a high probability that you could see a counter trending move arise from this. Now, as I stated before, if you are lucky enough to see a counter trending move arise, you would approach it the same way you would a pro trend move. The only difference is you will not be able to set your bias time frame targets. So if this is a daily high, you will not be able to set this as a target for a counter trend move. You will, of course, only be able to bring into consideration a short-term shift. For this, I recommend going back and looking at your daily highs or your daily lows. Again, this is dependent on your bias, and finding out what the average is for a given move. I would give you an average, but depending on what pair you're trading, what time frames you're using, the averages are going to be different and the probability of the average being hit is going to change. So you need to make sure that you apply this to your time frames that you have already in play, and you're using the Keep It Simple system and understanding to apply these concepts to the chart. So I'm not going to worry about showing you a reverse bias where we are bias bullish and we hit a high. I'm just going to go down to the charts and I'm going to show you some of the price action from the last week or so you guys can understand this, and then you're going to know the answer to the question, should we really ever go against our pre-established trend bias direction? Okay guys, so we are on the euro to the US dollar chart here on the daily time frame. Now you can see I have a selection of daily lows highlighted. Now of course there is going to be a different amount of daily lows depending on what direction you're traveling. If you look at the upside right now, there is not a huge amount of daily highs to be seen, but our bias has been bearish for this for quite some time, and we are continuing that bearish bias now. So what we're going to do is we're going to come down onto our entry time frame, which for me is the 15-minute, and we're going to establish what has happened at each one of these points, and you're going to begin to see the relevance of the times of when it can be appropriate to expect a against trend or counter bias movement. The rest of the time we should expect the lower end of the liquidity in a bearish trend and the upper end of liquidity in a bullish trend to be taken out accordingly. So let's go down to that time frame now. So here we are down on the 15 minutes. So we're just going to start up here at the highest point that we have marked, and we're going to pull this across so it meets the 15-minute low. Now what we're looking for is the money in, money out. And of course, if you don't understand this concept, then make sure you go and watch the Keep It Simple series. But for everyone that is up to speed already will know where I'm about to highlight, and you can see a very clear money out, money in scenario that happens right here, giving us a very clean counter bias move, a very clean counter bias move. And again, you can see this here. You will need to look at your pair that you use for probability, but because we took out a major liquid point on our bias time frame, it allowed us to change for a short period the direction that we expect price to run in. So example one, very, very clean. And again, you can go and do this on whatever pair you like. You're going to see very similar results in the way that it moves. Now, point number two, you can see that we actually have little to no reaction, which is great. This is the other thing that we'd expect to happen. If we do not react relatively quickly after taking this, you can see here we come down, we come down, we come down. We do have a small movement here. Remember, this is a counter trending move. But in this case, we only had an area produced here. Price action ran straight through it, which is relatively correct in terms of what our biasing is for price. We were expecting it to travel down, and our reaction happened quite far away from the initial point. If we refer back to the previous liquidation, you'll see the way the liquidation happened relatively close to the point that we changed our money in to money out. Here, on the other hand, we ran down a fair amount more before we saw that switch. Down to the next daily low, you can see the same thing happening here. We have a very clear money in, money out scenario, and we have a clear area given to us. Price action taps back into that, and we see a short-term bullish move. Again, these are short-term bullish moves, and we're expecting them to only run for a short period of time. But it can tell you that, hang on a minute, we may be in the seeking liquidity stage where we can begin to look for a more optimal setup for us for sell side. Again, down to the last example here, and you can see a very clear money in, money out scenario giving us an area that price can potentially run bullish from. Now in this case, we don't tap into this area, and this is current pricing. We don't run from this area, but we have a very clear bullish movement to the upside from the sweep of the daily low in this case, because that is our bias time frame. So take everything that I've shown you here, guys, and apply it to your current understanding of the Keep It Simple money in, money out concept. I hope you've enjoyed this short video that you can add on to your money in, money out principle. And I hope to see you all in the next one. Remember, guys, all the relative links are down below if you would like to follow us on socials, Discord, all of the good stuff. It's all down there. Hope you enjoyed this video, guys. Drop us a like, drop us a comment, and I'll catch you in the next one. Peace out.